Have you ever wondered how companies go public? And what is an IPO? Well, allow me to demystify this for you. IPO, or Initial Public Offering, is the golden ticket that transforms a private company into a public entity. It's the moment when a company steps onto the grand stage of a stock exchange, opening up its shares for purchase by the general public for the very first time. Intriguing, isn't it? So, why do companies decide to go public? Let's delve into it. Imagine you're a business owner. You've grown your business successfully, but you need more capital to expand further. What do? Well, one of the most common paths is to go public. By offering shares of your company to the public through an initial public offering or IPO, you can raise a significant amount of capital. This influx of funds can be used to fuel expansion, invest in research and development, or pay off existing debt. But raising capital isn't the only reason companies go public. An IPO can provide liquidity for existing shareholders. This means that those who have invested in the company can now easily sell their shares on the open market. Moreover, going public can increase a company's visibility and credibility. Being listed on a stock exchange can attract new investors, boost the company's profile, and open doors to new opportunities. Now that we know why companies go public, who can participate in an IPO? IPOs are not just for big institutional investors. Regular investors can get in on the action too. So, who exactly can participate in an IPO? It's a diverse set, really. First off, we have institutional investors. Think big organizations like banks, insurance companies, and pension funds. They typically get first dibs due to their financial clout. Next up, we have retail investors. That's you and me, folks. We can participate, but it's often through a brokerage firm, and you might need to meet certain requirements. Lastly, we have the company's employees. Yes, those working in the company often get a chance to buy shares at the IPO price, which can be a pretty sweet deal. Alright, so we know who can participate. But what exactly happens during an IPO? Let's break down the stages. The process of going public is not a simple one. It involves several critical stages. Let's dive into the journey of a company going public through an initial public offering, or IPO. First, the company must select an investment bank, also known as an underwriter. This underwriter plays a crucial role in guiding the company through the complex IPO process, providing financial expertise, helping to determine the IPO pricing, and assisting in marketing the offering. Next comes the due diligence and regulatory filing stage. Here, the company and the underwriter work together to prepare a prospectus, a document detailing the company's operations, financial condition, and plans for the future. This prospectus is then submitted to the regulatory authorities, such as the Securities and Exchange Commission in the US, for review and approval. Once approved, the company and its underwriter set the IPO price. This pricing stage is, in essence, a delicate balancing act. It involves setting a price that reflects the company's value, while also being attractive enough to entice investors. Finally, the stage we've all been waiting for, trading on the stock exchange. On the day of the IPO, the company's shares are available for the public to buy and sell on the open market. This is the moment when the company officially goes from private to public. So, now that we understand the process, what are the pros and cons of an IPO? Like any major business decision, going public comes with both advantages and disadvantages. On the plus side, an IPO can provide a company with access to a large pool of capital, which can be used to fund growth initiatives. It also increases a company's visibility, attracting potential customers and business partners. On the flip side, an IPO also brings with it increased regulatory scrutiny and a need to meet the expectations of shareholders, which can divert focus from long-term strategies. There's also the pressure to deliver regular shareholder returns, which can impact the company's autonomy and decision-making. We've covered a lot of ground today, but one question remains. How do investors and owners make money on IPOs? So, you've bought shares in an IPO. Now what? Well, there are two primary ways to make money from IPOs. The first is by selling your shares at a higher price once the company goes public. Alternatively, you can hold on to your shares and receive dividends from the company's profits. Both routes come with their own risks and rewards, but with careful planning and a bit of luck, they can prove quite lucrative. There you have it, the fascinating world of IPOs broken down in simple terms. Until next time, happy investing.